We found that time that the gathering was less, so we said let's delay it a bit so that people don't miss on the technical part of the topic, which is most important. The case studies in NPA, and who best can deal with them other than Dhananjay. Dhananjay, I have been hearing him for past several years, more than 20 years. Fantastic personality and a thorough person with the clarity on the thoughts of RBI circular, the advances, whether most of the time we have a question as a practitioner when the advances are at borderline. Are they to be classified as a standard or they are to be classified as NPA? And Dhananjay has been, not only a faculty but resource person for AASB on the various topic. Very proudly, I'm saying that he is a best friend, and we've, traveled across together. One of the person who is doing a training in Central Statutory Auditors program. Few days back, he was talking to all the Central Statutory Auditors of all the banks were there in the program organized by the PDICAI. I'm not going to talk much about the initiative, but Bhagyodaya is one such initiative, which is for the support and development of small and medium-sized practitioners, as well as the new practitioners who are entering into the practice. First program happening on next Saturday, 5th April, and thereafter on Sundays, 16 Sundays. So my sincere request is, those who are aware, it is good. Those who are not aware, please go to website and see the speakers, see the content of program. I'm sure you will love to attend that program. Theme for the year, I thought that I'll make a mention about that. The theme for the year is Zenith, that is the highest point. We all are working hard in the regional council to take the profession to the highest point during the year, wherein my Z stands for zeal, that is passion. We all chartered accountants are known for working passionately, and our family members keep saying that कि होली दिवाली practice में पता ही नहीं चलता है. Similarly, those students who are giving exam, they don't know when is a Diwali and when is a Holi. So that's the passion and dedication which we have for our profession. E stands for excellence. We all believe in our perfectionist. We do whatever work we do. I'm sure all of us who are in practice must be looking at whether it is a certificate or an audit report, few times before we sign, we must be reviewing it in detail. So that is where we work towards the excellence, and we at council will equally work for bringing the excellence in the entire activities of the council, be it publication, be it program, be it students activity. We will work towards bringing them to its best. N is nurture. Here we want to invite young talent and nurture them. Many of the program we are exploring that out of, let's say, 4 speakers, can a 1 speaker be a young speaker who is first time coming, having appropriate knowledge, work experience in those area. ऐसा नहीं कि किसी को भी हम यहाँ बुलाएंगे, but they get an opportunity. And there where we have rolled out a program called My Role at WIRC. So any young member who's got a talent, who's got a knowledge, and he wants to demonstrate, please come forward. WIRC is your platform. Our past president Aniket Bhai is to tell that I am the I in ICAI. Don't ask what ICAI can do for me, but you tell what you can do for ICAI. So taking that forward, we have concept of nurturing the young talent. I stands for integrity and ethics. We all are known for our integrity and ethics, be it again council affair or all the members in whichever areas they are working. I think the integrity and ethics of a chartered accountant is always at its highest level. T is again an important letter in Zenith, which signifies trust, transparency, and technology. We cannot work today without technology. We said yesterday, we published a book also on CBS, and you all have been given a complimentary copy. So technology, there's no choice. Similarly, transparency. So here, at least in council, you ask me anything, whether now, later, we are there 365 days. All of my office, whether Piyush Bhai is from Nasik, Fenil Bhai is from Ahmedabad, Vikas chairman is from Nagpur, Fortunately, Jinal Madam is from Mumbai like me. We are all available maximum time in WIRC BKC office, and any data, any information, any support you need, we are all available 24/7. Trust, the entire nation is trusting on this profession, and we have to maintain that trust for all the stakeholders. H is again hard work, harmony, and humanity. I don't need to tell about hard work to a chartered accountant. I'm sure all of us are working very, very hard and with harmony. On humanity, I spoke yesterday. Today, I have further data. In last 6 years, ICA CABF has given 26 crore rupees to 1700 families of a chartered accountant. That's where the humanity comes for us. Only in the year of COVID, 15 crore rupees was disbursed. One-time payment to CS family who were in need, who expired. I gave 2 incidents yesterday, which we saw in 1 month. I can talk about 10, but please keep in this mind, and this is the best place to donate. Whatever donation you must be doing in your life, but my request is at least 1 to 5% of your net profit or your salary. Please think about donating to the CABF through WIRC. We will be collecting the fund, and once the fund is of a sizable amount, we will remit. You will get all the details, whatever details you want relating to CABF. And also, if you find some chartered accountant who has expired and family is in need, please forward those details. We will be ready to help them out. With this, once again, thank you all of you for a patient hearing. Thank you so much.
Thank you, Chairman Sir. As said by Chairman Sir, all of us are committed to serve. So we are here available, and on the website our various programs have been put. So I request everyone to take active participation and collectively work for the profession. And few days back we have also circulated an email for study groups. So we are looking forward for your participation in those 8-10 study groups according to your area of expertise and area of interest. With this, may I request CA Dr. Fenel Shah, Treasurer of WIRC, to come and introduce to our today's learned speaker, CA Dhananjay Gokhale.
Thank you, Jinal ma'am. So before I take the opportunity to introduce the revered speaker and a professional from this particular field, I will take just a half a minute. As just Chairman sir also told that AI, which is a need of an hour, so we at WIRC are coming up with minimum 5 batches of AI, the certificate course of AI, every month. So the members at large can take the benefit of it. And apart from that, apart from a certificate course, also we are coming up with various one-day conferences of AI in various different, like AI in GST, AI in bank audit, something like that. Not only just for members, but also the article students. So please try to take the utmost benefit of the whichever initiatives are taken in the field of AI. CA Dhananjay Gokhale sir is a practicing CA, practicing in the field of corporate and banking sector, providing management consultancy and auditing and assurance services with a huge experience of 28 years. Sir is an author and has supported various publications of ICI magazines, and also in the guidance note on audit of banks since 2016 till date in all the editions. Apart from this, sir is a regular contributor to one of the sought after reference manual in India, that is a reference manual which is published by WIRC. Sir is a regular speaker on various platforms of ICI and other renowned organizations as a speaker, may it be on standards of auditing or accounting standards, or may it be bank audit. Apart from addressing and training and nurturing the professionals like us, sir play a very pivotal role in you can say mentoring the staff of various renowned organizations like Reserve Bank of India in College of Supervisors, the Staff Training Institute of NABARD, and the thing continues like so. So sir, we are so privileged and honored to have a renowned author, a renowned speaker, a renowned trainer, and a renowned supporter to all of us. And I would request all to join with a round of applause in welcoming CA Dhananjay Gokhale sir, the session for the speaker for the very first session. Thank you sir.
With this, may I request to present a memento to today's learned speaker. May I request our Chairman CA Ketan Sayya sir, Vice Chairman CA Piyush Chandak sir, and Fenil Bhai to join us to present a memento. Thank you. May I request Dhananjay sir to come and take the charge of the session. Thank you.
Good morning to all of you, and thank you to Chairman sir and Management Committee members. And as Ketan mentioned, actually, means I can call him Ketan even though he's the chairman. He's a very close friend of mine, and frankly speaking, he's one of the best faculties, which he doesn't talk about that. And we miss his speakership since he's on the other side now. And there has been a lot of instances wherein we have traveled together, we have talked on the same topic, we have changed the topics also at the last moment. So there are a lot of fond memories are there with him. So I just thought to just mention that before I start it off. As far as today's topic is concerned, I will be talking more about the case studies, because I believe yesterday already this topic was taken up. So I just give a kind of a starter for any pointer, and then I will go to the case studies. And I will just express my views about that. And what more I will focus about is what are the typical lacunas are there in the CBS system, and how that can be correlated with different type of maybe permutation combinations which are possibly there in banking sector. So these are the three circulars which you need to keep handy whenever you want to have a reference material. Besides, of course, the ICI Guidance Note 2025, which is there and available in PDF form, wherever you require a kind of a deliberation or elaborations on a particular topic. So first one is the Master Circular dated 2nd April 24. Second one is the Master Direction 17th October 2018, whenever the agriculture advances are verified. And third one is transfer of loan exposures, Master Direction, which is applicable only when you have a branch wherein maybe certain loan accounts or pool accounts are there which are bought from other banks, or maybe vice versa, that your account might have got sold out. So your branch might be only a collecting branch, and per se the accounts may not be there with your bank. Third possibility is that you are doing, say, an asset recovery branch, and in asset recovery branch you might come across a scenario wherein the NPAs are sold to ARCs, maybe at cash or maybe at by way of SR or participating certificate. So in that case, this third circular will be applicable. Otherwise, at normal routine bank branch audit level, this circular may not apply. So it's applicable only on case-to-case basis. So a couple of things before we start off. As far as NPA norms are concerned, RBI is very clear in the first initial paragraph itself that NPA norms are required to be applied in an objective manner. So there is no scope for subjectivities there. What I mean to say is that many a times bankers typically from the auditee side, they keep on saying that there is ambiguity. There is a scope for you to take certain decisions about whether account is PA or NPA. And in reality, that is not the case. There is nothing like practical banking or practical auditor. As an audit profession, what we do is rule-based audit. So if the RBI is setting up a particular rule, naturally that has to be followed, irrespective of what are the repercussions of that is there. Because wherever the regulator comes out with any guideline, there is a thought process behind that. So why regulator is coming out with a particular guideline is a kind of a redundant question as far as we as auditors are concerned. Bankers as auditee might be having their own concern which they can represent with RBI, but not with us. So we are not kind of a redressal mechanism system wherein the bankers tell us that how they have been treated differently by the regulator. But what we have to do is that we have to stick to the principle of what is a regulatory norm, and based on that we need to move on. Second thing is that whichever the criteria which is adopted for NPA classification or asset classification per se, that has to be adopted in a uniform and consistent manner. And we need to also pay attention that whenever we talk about the provisioning part, the asset classification comes first, followed by availability of security, and then what is the realizable value of that security. Now talking about realizability, the banks might be having different practices, which type of value they consider. So for example, if you have a valuation report, wherein say fair value is there, realizable value is there, and distressed sale value is there. So first ask the bank as to what is your policy about picking up which value for which circumstances. So maybe a bank might be there, wherein they pick up fair value whenever the asset or the loan is sanctioned. Later on, maybe for regular monitoring, they might be going by realizable value. So to arrive at MPBF, they might be going by fair value. To calculate the secured portion, in normal circumstances, they might be going by realizable value. When the account turns into NPA, they might be taking up the distress sale value. Now the challenge over here, practical challenge over here is, in CBS system, you have only one field to feed up. So whichever field you have updated first, that remains remains as a permanent field unless until you update that field. System will not understand that earlier it was a fair value at the time of sanction. Later on, we need to change to say fair value. And then maybe at a particular point, we need to change it to distress sale value. Because some banks have a policy that in substandard category, they continue with the realizable value because it is just for 12 months. When it turns into doubtful, some banks say that we'll now go by distress sale value as a conservative principle. Principle is fine, policy is also fine. What we need to verify is that whether that policy is adoptable in the CBS system or not. Because making a policy is an easy thing to do. But to work with technology is something which the bank needs to adopt. Now this was about immovable property. If we come to the movable property, lesser said is better. Many times whenever say a machinery loan is given or a vehicle loan is given, the cost is fed in the system. At times it is inclusive of GST. So that is the first flaw which many times is there. Because whenever the ITC is available, naturally you are not supposed to even factor in that. Suppose ITC is not available, still that value, that is the realizable value, is always without GST. Because you cannot go by cost which is incurred by that particular auditee or that borrower per se. You have to go by the realizability of that. Now when you talk about realizability, you need to factor in that GST is not forming part of your cost. It is a tax which you are paying. Because if you go by that logic, even TCS will also get added, in certain cases. Now that logic cannot work. You have to go by the cost. So verify that whichever accounts you are picking up for verification in LFAR also, verify that the master data is also verified by you. Maybe that is not having a significance today when you are doing the audit because in the current year typically all these are standard asset. Going forward that value might be required to be crystallized and it has to be an accurate way. Second thing is that over the period naturally the value has to deteriorate in a gradual manner. So maybe suppose it is a vehicle loan, presumingly that suppose 5 years is a useful life. I'm just saying a hypothetical figure. Bank should have firstly the policy as to how that value should be depreciated. And then we need to ask them that how you are making this value depreciate over the years based on system based working. I have yet to see a CBS system wherein the value gets deteriorated not in that sense, depreciated I should say over the period. So again manual intervention is there. So practically what we talk about automation in system has a limited scope. Manual intervention is there every year for every movable property. Now how to do that and how the bankers are able to do that is it's a kind of a different question. Then as far as responsibility is concerned, just pay attention to this para 5.1.1 wherein RBI is categoric that requirement of provision has to be adequate and the responsibility is on both actually, auditee as well as auditor. Typically if you have seen any RBI circular, that circular is addressed to the bank. So theoretically it is not mandatory for us or the circulars are not for us actually, they are for the bankers. Except this circular wherein the para is very categoric about that the provisioning requirement and adequacy of that is responsibility of both, that is auditor and auditee. So you are equally responsible as the bank. So it's kind of a joint responsibility which you are holding with auditee, which usually is not the case. So even though we write in management responsibility paragraph that it is the primary responsibility of the management and all these things, here it doesn't work. You are equally responsible. There is nothing like primary and secondary responsibility. So just keep this thing in mind. One more thing, coincidentally, I just wanted to ask to all of you, how many of us have Banking Regulation Act in their offices? Very few. And how many have Income Tax Act? Almost all you are having. But still we do the bank audit without having the Bear Act with us. See why I am saying that is, under whichever act applicability is there, you need to at least be aware about what is expected from the auditor. Because in every act there is typically 1 or 2 sections are there which talk about responsibility of the auditor, powers of auditors and what one has to report that. Now why I am giving these references, if you refer to the BR Act, 3-4 provisions are vital, as far as bank audit is concerned. First one is that as far as dividend declaration is concerned, the dividend declaration is conditional. Now, one of the condition is that it has, bank has to ensure that the provision is made to the satisfaction of the auditor. It doesn't talk about IRAC norms. So IRAC norms provision is the minimum provision which the bank is required to do. If as an auditor, if you feel that additional provision is required, you have every right to suggest the bank along with reasons that why additional provision is required. So let's take an example that suppose you have a substandard asset and it's a secured asset. So 15% provision is made, but you are of the opinion that there is a likelihood that substantial portion is going to be non-realizable. You don't want to classify that as a loss asset. In the sense, it's somewhere between that. It is yet to lose that entire portion of recoverability, but still, there are chances that additional provision is required. You can always ask the bank by citing the reasons that make an additional provision. We don't want to mark that as a loss asset because it is not entirely unrealizable. But I want to make a 50% provision. Just to give a practical example, suppose there is a case wherein the borrower has deceased and the legal heirs of the borrower are giving undertaking that we will make good that claim whatever the bank is making, but still it is in negotiation stage. Security is not adequate, maybe it's half or maybe it is say 40%. Now in that case, as a prudent auditor, you can always suggest that unless and until there is a contract which is entered between the legal heir and the bank, there is an uncertainty involved. So don't just mark it as substandard because recoverability is anyway not there. So you can make an additional provision by keeping that class intact. So that is a power which you are having by way of BR Act. Second BR Act provision is that as far as non-banking assets are concerned, only immovable properties are permitted to be taken as non-banking asset. Movable properties bank cannot transfer in their own name. So that is the second provision. Third important provision is that what you express the opinion about in your audit report, that is explicitly stated in Banking Regulation Act, which doesn't talk about true and fair view. It talks about true balance of profit or loss, whichever is the case. So it's kind of arithmetical calculation which BR Act asks you to certify. It's something different than true and correct. At the same time, it is not true and fair also. It is true balance of profit. So that's the provision which is there in the BR Act. So just be aware of these things whenever you are undertaking any audit. I will just skip this part and I will directly come to the point and take the practical example. Let me just first give a background about what is the RBI guideline about classification of term loans. As far as term loans are concerned, if any amount which might be say interest, principal or EMI, if it remains overdue for a period of more than 90 days, the account will be marked as NPA. Now the vital point over here is the 91st day the account will become NPA. And the first date of default will be the date which is the due date for that repayment which has been scheduled by the bank. As far as definition of overdue is concerned, the definition is amply clear, which is specified by RBI, which requires 2-3 precautionary measures which the banker is supposed to take. First one is that in the sanction letter, the exact due date is required to be mentioned. So it is not only monthly installment which the bank is supposed to mention, they have to be pinpointing that which is the due date. So suppose 10th is the due date. If the borrower doesn't pay by 10th, on the 10th end of the day, the account will become overdue. So that will be the first day. There is nothing like past due concept which exists in any of the account, whether it is a term loan or whether it is any other type of loan. So past due concept was a concept maybe 10 years back or 15 years back. Now the concept is not there. So the first date will be that, and on 91st day, the account will turn into an NP account. Second thing is that as far as these repayment schedules are concerned, you need to always refer to the sanction note and the sanction letter. Now what is required to be communicated by the to the borrower by the bank is, the bank is required to communicate the entire repayment schedule to that particular borrower. In the sense, borrower is always aware that which are the due dates, what is the composition of principal and interest, and what will be the ideal drawing power, that is the ideal outstanding balance, presuming that he is exactly paying on the due dates. So suppose 10th is the due date, and if as a borrower I am paying exactly on 10 date, then that repayment calendar will give me the exact balance outstanding at any point of time. Now that is the whole basis actually, based on which you can calculate the overdue component. So you need to compare on any cutoff date. Any cutoff date is every end of the day. You have to compare the ideal drawing power, that is the ideal ledger outstanding balance, with the actual balance. If your actual balance is more than ideal DP, naturally there is a overdue component. Then you have to factor in that overdue component and decide that it was overdue since when. And since when's date, once it crosses 91 days, then the account will become NPA. So let me give you couple of practical examples related to that. So let's first talk about how the demand satisfaction happens and how you can calculate that overdue since date. So let me give you one simple example. So let's presume that 10,000 rupees is my EMI, and as on 31st March, presuming that 31st March is the cutoff date, my balance outstanding and the difference between balance outstanding and ideal DP is say 35,000. If that is the case, naturally by normal calculation I will say that 3.5 installments are overdue. So indirectly fourth installment is overdue, that is the last installment or the latest installment I should say. So I will go backwards and see that overdue since date is which is the date. So suppose 10th is due date. So 10th March, 10th February, 10th January and 10th December. So from 10th December the account is overdue. So 10th December becomes my first day, and on 91st day, so typically maybe 11th March or 12th March, my account will be marked as NPA. So that is as far as normal manual calculation is concerned, this example is correct. Now let's take a kind of a different example. So let's presume that in that particular account, the bank has debited insurance charges to the extent of say 15,000 on say 18th of March. Now when I talk about this 35,000 adverse difference, what I need to consider is I have to go from bottom to top, that is from last date, I have to go backwards, that which are the demands which are generated. Now as far as insurance charges debits in term loan account is concerned, that is required to be immediately paid because that is over and above your EMI. So whatever excess is debited in the account, that is due on the same date. So suppose that particular borrower hasn't paid anything beyond EMI, naturally 15,000 would have become overdue. Now out of this 35,000, if I go from top to bottom by say a LIFO method, then first 15,000 is due on 18th of March. That is the date on which the amount is debited. Then next 10,000 is 10th March. Then next 10,000 is 10th February. So this 35,000 comprise of 15,000 due on 18th March, 10,000 due on 10th March, 10,000 due on 10th February. So my overdue since date is 10th February and not 10th of December. So don't just go by manual calculation. You need to verify that how the CBS system is working and whether the CBS is correctly formulated or not. Now how to formulate that correctly is that ideally the CBS system should have a flow, that is a demand flow, wherein let's say 10,000 comprises of 8,000 principal and 2,000 interest. And let's presume that 10 December is the first installment due. So the demand calendar will be maybe say 2,000 rupees is due on 10 December, then 8,000 is due on 10 December, then again 2,000 due on 10th of January, then 8,000 is due on 10th of January. Like that the flow has to be there. So whenever any amount is paid, naturally the amount should be on a FIFO basis. The demand satisfaction has to be on a FIFO basis. So just verify whether the CBS is correctly calculating these overdue sins or not, or whether it is a manual process as you and me do on a manual basis, because that is not supposed to be the case. And remember that as an auditor, you are required to have a true and fair view. So suppose an account which is otherwise a performing account is marked as NPA, you have to pass a MOC to rectify that error and say that it is a performing account. The example which I just now gave you, that if 35,000 comprises of overdue since 10th of February, if the bank or the CBS system is marking that account as NPA, that's a wrong kind of a calculation. You need to rectify that also. So don't hesitate to pass a MOC to convert NPA into PA. Vice versa, I need not have to tell. All of you are expert in that. Wherever the account is NPA, naturally we pass a MOC. But other way around also is something which you need to look at. So let me just show you one more example. Taking this example further, or let me take you one more example. Let's presume that there is an advance repayment of installment which is made. Now typically what really happens is, suppose say 10,000 rupees is my installment, if I pay say 3 installments in advance. So naturally for next 3 months, even if I don't pay anything, my ledger balance will be always less than my ideal DP. So the account is not overdue. So there is no question of marking that account as NPA. Interest might be debited in the account, but interest is unrealized but not overdue. Because overdue concept is that my ledger balance should be more than my ideal DP. Now in that case, it is interesting to see that how the CBS systems behave. So let me just show you one example. Now here let's presume that 10,30,000 is the balance and 10,000 is my EMI. And I'm just taking a hypothetical figure that 6% is the rate of interest. Now this is how the account will typically look like. Now against 10.30 lakhs, instead of 10,000 rupees, I'm paying lump sum of 30,000. And there are interest debits which are happening subsequently. So this 30,000 will take care of my subsequent month's installment. that is installment of March is anyway taken care of. So March, April, May. So these 3 months I don't have to pay anything. Suppose I still don't pay further, my account might turn into NPA maybe in July, August, September. So somewhere in September, my account will be marked as NPA the moment I cross that 90 days barrier, that is on 91st day. Now here two things are there. First thing is that one should not go by interest servicing concept, because there is nothing like interest servicing which is related with NPA. Because many a times some banks, or few banks I should say, they have a concept wherein they might say that on 31st March 5,000 rupees is the interest which is debited, then April and then May. So since my three interests are not serviced, I will mark that account as NPA, which is a wrong notion, because overdue concept is not about realizability. Overdue concept is about non-payment of dues which are due on a particular date. Now here the next point is that let's presume that on 30th September the account is marked as NPA. Once account is marked as NPA, you need to calculate that what is the quantum of interest which is unrealized, and you have to reverse it or provide for it. Now when you do that, actually you have to go by normal accounting concept. Accounting concept is that first the interest should be debited in the account and subsequently something has to be credited, then only it is realized. Now here if you look at it, on 3rd of March 30,000 rupees is credited in the account and subsequently all debits are there. Now this 30,000 you cannot use for subsequent realizations because the amount is already adjusted against the outstanding balance. So naturally when I mark this account as NPA, March to September, this 7 months interest, which is say 35,000, that entire amount will be considered as unrealized and that is required to be reversed or provided for. In some CBS system they have a concept where they call it as an overflow. So out of 30,000 they say that 20,000 is overflow. So it will take care of my March, April interest components. Now this concept is wrong for a simple reason that if I want to go with this logic, that next advance installment is paid, so interest is also realized. Now if that concept, if I want to adopt, I have to adopt that in accounting terms also. Now what I mean by accounting term is, then I have to say that on 3rd of March, I have received interest which is going to accrue in future. So it's an interest received in advance. So going by these 3 installments, maybe say 5,000, 5,000, 5,000, I need to say that out of 30,000, maybe say 15,000 is a component of interest which I have received in advance. And the moment if I say that interest received in advance, it becomes my liability. Something similar to bill discounting, wherein it is taken on a time proportionate basis. Now CBS system doesn't pass this accounting entry. It will say that outstanding balance as on 31st March is 10,03,000. The moment I have already adjusted against my ledger balance, subsequently I cannot use it for servicing of interest. So unless and until it is parked separately, I cannot use it for my interest realization concept. So the amount of interest unrealized has to be 35,000 and it shouldn't be like, first 3 installments adjusted against that and 15,000 is not the correct preposition. Now where the CBS systems are doing error is, they calculate the overdue component and out of overdue installments, they consider the interest portion which is not realized instead of going by accounting concept. So be little vigilant about that accounting entry to be passed. One more thing, as a coincidental matter, I will just like to add. As far as RBI circular is concerned, there is a peculiar thing which is specified in the RBI circular and which most of the times is flouted in the CBS system. What the circular is specifying about is, once the account is marked as NPA, as all of us are aware about that, subsequently interest should not be recognized. Now the interest accounting is also specified in the circular. They are talking about memorandum account. Now memorandum account is definitely not the advance account, because otherwise it would have been said as an advance account. Now what kind of CBS systems are following as accounting practices? In some CBS system they have a IR/OIR concept subsequent to date of NPA. That is a contra entry which will keep on accumulating. In some CBS system, the amount gets debited in the account and there is a corresponding OIR which is created. So income doesn't get recognized, but it is getting hit into an advance account. Now if you look at the RBI circular talks about a memorandum account. Now both the practices are not exactly the memorandum account. At the most we can say that IR/OIR is a memorandum account. It's a account which is other than your advance account. So just verify the CBS system and see that whether it is exactly in compliant with the RBI circular or not, even though it may not be impacting your P&L account, because the circular has to be followed as it is. You should not think about whether it is affecting my balance sheet or P&L account. Let's take the second example. Now here, again the presumptions are almost same, and this is a typical case wherein it's a flowing account. Now let's presume that in this particular case there is a component of interest recovery which is happening in between that particular period. Now NPA date is say 29 July 2022. Now here again, whenever you want to calculate that what is the quantum of your interest unrealized, you have to go by accounting concept. Now let's take this example. 10,000 is my EMI. So 10 lakhs is the balance on 1st of March, brought forward balance. Now there is interest debits which are there March and April. Subsequently one installment is paid, that is 10,000. Again interests are debited. The account is marked as NPA on 29 July, that is the 91st day. Now in that case, if you go by demand satisfaction logic, which most of the CBS systems are having, what they do is, presuming that say interest is 5,000, principal is 5,000. So the first due is say 31st March, first installment is 31st March. So on 31st March, demand is 5,000 of interest, 5,000 of principal. Then on 30th of April, again 5,000 interest, 5,000 principal is the demand. Against that, on 1st of May, 10,000 rupees is recovered. Now 10,000 by way of demand satisfaction, it satisfies the demand of 31st March. 5,000 interest demand is satisfied. Subsequently 5,000 principal demand is satisfied. April demand is still open. Now in these CBS systems, what they calculate as a unrealized component is April 5,000 rupees interest, May 5,000 and June 5,000 based on demand calendar, because 15,000 demand is not satisfied. Now here the answer is incorrect based on accounting principles. If you go by accounting, your 5,000 to 5,000 rupees amounts which are debited in the account, they are getting serviced by subsequent 10,000. But the system will throw you the amount as 15,000, which is again incorrect. Amount of unrealized interest is only 10,000. So there is a subtle difference between what is overdue and what is unrealized. Both may not sync with each other. So verify the systems as to how they are working. It is not necessary that your unrealized interest should be always on a higher side or a lower side. It depends upon the circumstances. So firstly, when you mark that account as NPA, go by overdue concept. Subsequently, go by realization concept, which is accounting concept. And make a combination of that. And believe me that in most of the CBS system, you will have ample of MOCs based on that only. I am not advocating that you should pass multiple MOCs. I'm just giving an instance where the MOCs are literally bound to be there, especially in these typical instances. Yeah. Then one more thing, which I just wanted to add over here, that whenever you are talking about EMI will always consist of principal and interest, right? Now, whenever there is no change of rate of interest is there, ideally EMI has to be a static component, means your repayment calendar should never undergo change. Now what happens, in certain cases, let's take, a couple of examples. As far as, a simple example is concerned, let's, presume that 10,000 is EMI, 10th is the due date, and let's presume 8,000 is my principal and 2,000 rupees is my interest component. And as a borrower, instead of paying on 10th, I am paying it on say 20th. So if I delay that, there will be naturally additional interest component which will be always added over and above what is there as an ideal repayment calendar. So let's presume that 8% is my housing loan interest. So for 10 days period, maybe 100 rupees additional interest is there. So instead of 2,000, my total interest is 2,100 because I have delayed that by 10 days. And let's presume that because of delay, there is a penal charges which the bank has levied on me, which was earlier called as penal interest. So let's presume that is 20 rupees. Now if I don't pay that additional 120 rupees, ideally at the month end, if I pay only 10,000, my overdue component has to be 100 plus that 20, that is 120 rupees. Now the CBS system doesn't work in that fashion. In some CBS system, this 20 rupees penal charges, they presume that it is immediately due. So only 20 rupees are shown as overdue. And what they do with 100 rupees is quite interesting. What they do is they change the composition of EMI in that month. So instead of 8,000 plus 2,000 composition, they take that principal amount as balance amount. And interest is replaced, that 2,000 is replaced by actual interest. Now let's look at the ramifications of that. So my 2,000 will become 2,100, my principal will become 7,900. So this 100 rupees is principal component is there which I am not going to collect. My demand calendar has changed. So whatever I have shared with my borrower, now my demand calendar is not in sync with that. Now all such 100 rupees, they are ballooned together and they are shown as due at the end. That is, maybe suppose it is a housing loan, at the end of 15th year, all such accumulations will be there. And at that point of time, instead of 10,000, I might be having a liability to pay of 25,000. Now what I have done is, I have given a concession to the borrower that instead of paying 10,000, 8,000, you just pay 7,900 as principal. 100 rupees I am going to extend. There is an additional period which I am giving. So pay me at the end. Now if I do that, it amounts to a restructuring process, because this is a concession given to the borrower. And naturally the account should have been marked as NPA, because restructuring, once you do that, it will instantly be downgraded. So just verify that whether the EMIs are static or dynamic. If they are dynamic, this ballooning might happen. Now let's take an opposite example. Now instead of 10th, I have paid on say 5th. So my interest instead of 2,000 is say 1,900, because I have prepaid that. So naturally, because of prepayment, my interest component is going to reduce. Now here again EMI is also again affected, but now in a different way. My 2,000 will become 1,900, my principal becomes 8,100. Now what is the impact? My last installment will get reduced. So if I keep on paying little bit in advance, my last installment might extinguish. Now it will be an odd scenario. My account due date is say March 2030, for example. But my account will get nullified as per the repayment calendar, maybe in January 2026 itself, because I have prepaid earlier. So ideally my repayment calendar has to be static. It can never become dynamic, because otherwise there is no point in even calculating that repayment calendar. It is as and when kind of a proposition, which is not supposed to be the case. Now how to pick it up, how to pick up these cases. What you do is just take up the jotting, look at typically SMA1 or SMA2 accounts with a longer tenure, typically housing loans, and just choose some SMA2 accounts which are in 5th or 6th years. And then just go to the repayment calendar, go to the last installment, and you will get all these case, kind of a ready-made cases you will get, wherein the last installment is balloon. The moment that balloon installment is there, you can always put forth this as your comment by saying that NPA system is not automated and not working correctly, because you are changing the entire repayment schedule itself. Let me share with you interesting cases without naming any bank and any software for natural reasons. In last couple of years I have seen a couple of banks which have a novel concept in a different way. They had sanctioned housing loans typically in pandemic period, which were linked with repo rates. So at that point of time, repo plus certain percentage rate used to be at 6.5% or 7%. They were very low rates were there at the peak of pandemic, typically in 2020-21. Now the repo rate has increased. So let's presume that now the rate is 9.5%. So naturally interest will be going to be on a higher side. So ideally what the bank should have done, either they should have extended the EMI repayment period, or they should have increased the EMI. There is no other third method. What these banks have done, they haven't done anything. So what happens is that interest is calculated at actual, that replaces my EMI component of interest portion. So at times it might happen that in few cases the interest component might be more than my EMI amount. So even after say 3 years or 4 years, my principal outstanding might be more than limit, which typically should never be the case in any term loan account. Forget about the logics of IRAC norms and other things. If for 3 years someone is supposed to repay, at least his balance should be less than his limit. That is a minimum, kind of a criteria. Going by logic, I am not even getting into IRAC norms. But these things are prevalent. Systems are not throwing it up. The reason is that the CBS is, worked out in such a way that they replace that, interest component with actual. And they presume that, that is a DP. That is the ideal DP, because it is dynamic. So every time DP gets increased beyond the limit. They don't even have a check, wherein at least they should verify that ideal DP should never be more than limit, unless and until there is a capitalization of interest which is a part of a sanctioned term. But in that case also, limit is always on a higher side. Disbursed amount might be on a lower side. So these flaws do exist, at least till last year. This year I don't know, maybe next week all of us might be knowing that. So be little vigilant. Don't presume that when you go by just by defaulter list, you are going to get the correct answer. So verify the normal accounts, which are standard accounts, which might be appearing to be not appearing in defaulters list, but in reality they are in defaulters list. And how to report that also, few suggestions from my side. Firstly, whenever the automated NPA system is not working, you can very well qualify your main audit report, because it is a regulatory violation. RBI has specified in the master circular that every bank is required to adopt an automated system of NPA marking, that is IRAC system, So it has income recognition, asset classification and provisioning. All these three things are supposed to be system based. If there is a deviation or if the systemic flaw is there, you need to qualify your report, whether qualified, modified, that is, or adverse report, that is your choice. But make it a point that even your main report, this issue is getting flagged, because then you cannot rely on the system. If the system is behaving in a strange way, naturally you cannot say that NPA is correctly calculated. Now one more thing is that as far as interest funding is concerned, in some cases there might be a case wherein for moratorium period, interest is also financed by the bank, typically housing loan cases, wherein 95% might be disbursed and 5% might be the interest component for say first 6 months, which is also getting capitalized as a part of sanction terms. So the EMI will start on that 100 rupees, not on 95. Now in this case, if such account turns into NPA, that 5 rupees which is capitalized, that amount is not required to be reversed, because that is capitalized and it is part of your sanction term. But in all other cases, the moratorium period interest is also will be required to be reversed if the account turns into NPA. Now as far as moratorium period is concerned, just look at the conditions of moratorium period. That in some cases, it might be the case that principal is having a moratorium repayment period, but the interest is payable as and when. There might be a case wherein interest moratorium is given for say 6 months. So after completion of 6 months, the entire interest component is due. So that will be the due date, and from that 90 days you need to wait, to mark that account as NPA. Then as far as staff advances are concerned, the repayment schedule is altogether different. So go by that repayment schedule, which typically is first principal is repaid and later on interest payment is there. Now staff advances per se might also turn into NPA. Let me give you a typical case. Like suppose, there is a staff who has been hospitalized maybe for last 3 months. So he's not getting the salary. So naturally, since he's on, leave without pay, there is no question of recovering any amount from him. So such accounts can also turn into NPA. So be vigilant about that. Having gratuity attached to that account doesn't absolve it from NPA provisions. NPA is uniformly applicable for all, including staff loans. So there is no exemption or differential treatment is there for staff. Then bill purchase facility. The rule is that whenever the bill discounting is overdue for more than 90 days, the account will turn into NPA. Now let me tell you certain intricacies related to that. First is that as far as exposure is concerned, for LCBD facility, the exposure is always on the bank which has issued the LC and not on the borrower. So it might happen that the borrower is having CCOD facility, term loan facility and LCBD facility. So CCOD and term loan turns into NPA, LCBD will remain into standard asset category because the exposure is not on the borrower. For example, suppose you are doing audit of SBI and Bank of India's LC is discounted. So the exposure of SBI is not on the borrower but on Bank of India. So that LC remains intact, LCBD remains intact, and other portion might turn into NPA. Now let me give you one more example. Suppose that particular borrower is having 2 LCs which are discounted. One is by Bank of India, another one is by SBI itself. That borrower's customer is also having an account with SBI. So SBI itself has issued a LC. Now SBI cannot take exposure on its own. So then the exposure is on the borrower. Now in that case, such LCBDs will turn into NPA accounts. Now let's correlate that with CBS system. So ideally, what the CBS should capture as a master data is, whenever LCBD is given, the LC issuing bank's name has to be captured, because I am taking exposure on that. So the CBS system should be able to distinguish between Bank of India LC and SBI LC, which is not the case with CBS systems. It doesn't capture the data. So either it will go by rule that all custody related exposure will turn into NPA. So Bank of India LCBD will also be NPA. That is one probability. Other way around is that the CBS system is equipped in such a fashion that all LCBDs will be always PA. Either of the one, one has to choose, because the master data is not there. So verify that whether that master data field exists or not, and then the question of, system-based NPA will arise. If master data is absent, no system can practically work. So this is one example. Now let me give you one more example. Suppose it is foreign LC. Now in foreign LC, the exposure is never supposed to be on the bank. It is always on the borrower, because the bank is outside banking system in India. So in that case, it is not the borrower, it is not the bank-based exposure, but it is borrower-based. Now in rare cases, it might happen that the LC issuing bank has gone defunct. Now in that case, such LCBD will simply turn into a loss asset category account, and then all other borrowers' exposure will also turn into NPA. So let me just give you an example. In 2019, there was issue with PMC Bank, which all of us are aware about. So PMC Bank might have issued a LC. Some bank might have discounted that LC. Now since PMC was defunct, naturally those LCs were not immediately honored by PMC or subsequently Unity Bank. So naturally, since they are not honored or PMC Bank was defunct, indirectly the exposure on PMC Bank failed. So the account turned into NPA. Now let's presume that such borrower was also having a CCOD or term loan facility. Then what the bank will do, the bank which has done the LCBD, they will invoke the rights of recovery against the borrower. So it will not be only for LCBD, but even for CCOD term loan accounts also, the account will get marked as NPA. Now of course these cases are rare actually. They don't happen on year basis, but in case if it happens, just make sure that you are turning that into a loss asset because there is no underlying securities there. So LCBD facility, typically all the banks presume that it is a secured loan without having any underlying tangible security. So once you lose the security, which is only in the form of guarantee which is given by the bank, naturally the account will turn into a loss asset category account. Then agriculture advances, the 90 days criteria gets replaced by crop seasons. So if if it is a short duration crop, then 90 days criteria gets replaced by 2 crop seasons. If it is a long duration crop, wherein crop season is more than 12 months, 90 days will be replaced by that. Now couple of vital points over here. First thing is that verify that how the CBS system is able to capture all these things. In the sense, suppose there is an agriculture loan. So first and foremost thing is that you need to satisfy yourself that it is an agricultural loan. Loan given to farmer per se is not an agricultural loan. It depends upon the end use of that. So suppose a gold loan is given to a farmer where the end use is that he has gone for maybe a trip to Switzerland. You cannot call it as an agricultural loan. The end use is altogether different. Now in that case, his other accounts might be agricultural loans, but this AGL account need not be agricultural loan. So always verify that what is the nature of loan or the nature or the end use which is there. And end use is something which bank has to prove before you and not vice versa. Bank cannot tell you that he is a farmer, he has a KCC, so his AGL is also going to be a farm loan or a farm credit. That is not the rule. The bank has to prove that how the end use is taken care of. Now couple of practical challenges. In many cases, the AGLs typically are disbursed in such a way that the entire amount is credited to the saving account of that particular fellow. He withdraws the cash. So there is no nexus in the disbursement and the end use. Now here actually you need to ask the bank to represent before you as to how they are monitoring the end use and on what basis they are saying that it is agricultural loan. Because if it is not an agricultural loan, the entire NPA norms are altogether different. The 90 days norms will apply instead of crop seasons. Now let's presume that end use is proved, on the record. Maybe a site visit is there, some report is there. How they prepare is a different thing, but let's presume that, the report is there. The second case is that then you ask the banker that what is a crop season and on what basis you are saying that this is a short duration crop or a long duration crop. So naturally the borrower has to give some declaration to the bank. And typically in case of KCCs, on a year-on-year basis, that has to be updated also. Because the presumption that in first year, the farmer might have taken short duration crop, it doesn't mean that in next year he will be going for long duration or vice versa. He might be changing the crop pattern in his farm. Now the bank has to ensure that that is updated. So many times you will observe that initially whenever the account was opened, something must have put in the CBS system which just continues for 5 years, 6 years or 10 years. Now that is something which talks about the manual intervention requirement in agriculture loans. Second thing is that as far as interest calculation is concerned, the interest calculation methodology is specified by RBI, wherein the interest is always due only on the basis of crop seasons. Now what happens in many banks? There is a presumption that on 6 monthly basis the interest will be levied. In some banks they levy it on a monthly basis. In some banks they do compounding also. Now first and foremost thing is that for agriculture loan, compounding is not permitted unless and until crop season gets over. So verify the CBS system as to how this crop season is captured. So what typically will happen is, presume that you are doing an agriculture based branch. So there is maybe 10 farmers are there who are taking a short duration crop maybe of 7 months. Another set of 10 farmers are there who are taking a long duration crop of say 14 months. Now in both the cases, the interest charging or the interest due dates will be different. Now see that how the CBS system is able to capture that. Whether the CBS system is equipped with state-wise SLBC norms as far as the crop seasons are concerned, and whether that data is getting captured or not. If the data is getting captured, then only the system will work. Otherwise, you and me are there to manually calculate that. And that's what precisely happens in most of the banks. So be vigilant about this agriculture credit. And don't rely on the system beyond the point. Unless and until you have tested the system, that the system data updation is accurate, it is periodically done, interest calculation is correct, and the end use is monitored. If all these three things are positive, you can very well rely on that. But this is kind of rarest of rare thing, wherein all these three things are in sync with the reality and they are regularly updated. Now let's come to the point about reschedulement. As far as reschedulement are concerned, for short-term agricultural advances, reschedulement is possible only when there are no overdues as on the date of happening of a natural calamity. And then there is a prescribed method as to what extent you can extend that particular repayment. Now here 2-3 points as a checkpoint. First thing is that whenever you are saying that there is a natural calamity happened, make yourself satisfied that the particular district is covered under natural calamity. That is the first thing. Second thing is that the extension which is there, which has been prescribed. So the extension of repayment is up to 2 years and 5 years depending upon the crop loss. So what typically becomes is these short duration loans, which are typically KCCs. KCCs will turn into term loans, maybe of 2 years or 5 years duration. So firstly, the nature will change. So from KCC, it has to go to a new account. And in new account, the repayment will start with a minimum 1 year moratorium period. So that is minimum. Bank can give 2 years moratorium also. That is very well permissible. And as far as long duration or long-term agricultural loans are concerned, up to 5 years extension is possible. Now, if any of the conditions are not satisfied, like say short-term agricultural loan, there is a overdue component of say 5,000 rupees. Then reschedulement is possible, but then the account will get downgraded. So there is no bar on which account should not be rescheduled. Any account can be rescheduled. These conditions are specified only to ensure that only this class of asset will retain the class. And in case of others, it will get downgraded. Now typical issues which are there. Many times the crop insurance proceeds are received maybe in the next year. Last year the natural calamity is there. In the next year you received the crop insurance proceeds. Now these proceeds should not be credited to the running KCC account which is as on today. It should go to the restructured account because the crop insurance is received against that affected loan. So it should not be used by the borrower in the current year. It should not be adjusted against current dues, but it should get adjusted against the original dues which were there. So just verify that how the crop insurance proceeds are treated by the bank and whether earlier loan is getting satisfied against that crop insurance. So these are few points which we discuss. So I just put in as a bullet point. Then as far as derivative transactions are concerned, normal 90 days concepts are there. Liquidity facility also 90 days. Credit card dues, slightly different concept, wherein the minimum amount due, if you don't pay it in next 90 days from the due date of credit card statement, then only the account turns into NPA. Then the last category is cash credit accounts, CCOD accounts. So if the account is out of order, so if any of the three conditions are getting satisfied, the account will turn into an NPA account. So these are basic conditions, no change in that condition is there, but we'll just see certain intricacies of that as to how the things might look differently and may be treated differently in, by the banks or the CBS system. Now first thing is that as far as these limits are concerned, all these limits are subject to availability of drawing power. So drawing power plays an important role, and you need to also be ensuring that what is the effective date of that drawing power, because based on that your overdrawing might undergo change. So let's take a couple of examples. Let's take first case. Now as far as the stock statement submission is concerned, the stock statement will be submitted on various dates. So maybe say January stock statement might get submitted on say 15th of February. And let's presume that 10 lakh rupees is my limit. My DP for December based on December stock statement was say 11 lakhs. So 10 lakh limit is entirely enjoyable by me. In the month of January, my DP has reduced. My DP is now 8 lakhs. And since maybe say 1st of January, my account is continuously overdrawn. But in the first week of February, the account is brought within the limit to the extent of say 9 lakhs. Again, the account is overdrawn, maybe from 10th of February onwards. I submit the stock statement on 16th of February, which has a DP of only 8 lakhs. Now this 8 lakh DP, you need to ensure that what is the effective date of the DP which the bank is considering. If I consider that prospectively, my dipping of that 9 lakh will be considered as regularization of the account. If I consider that 8 lakh from 1st of February, naturally my 9 lakh dipping is not of any use because my DP or limit whichever is lower was 8 lakhs. So account is still continuously overdrawn. Now you need to see that how the CBS system is built with the logic. So verify that whether the effective date is entered by in the system and whether that is working correctly for overdrawing. Because if it is not working correctly, you may not get the defaulters list. In the sense, this particular account will presume that prior to 16th of February, the account is already regularized. So the continuously overdrawn counting will start maybe from 11th of February onwards and not prior to that. So verify that this effectiveness is correctly captured. Because otherwise, what the borrowers will start doing, whenever the DP is not there, he will submit the stock statement maybe in the last week itself. So he enjoys the full operational powers throughout the period. Continuously overdrawing is already compromised. So the correct calculation of even SMA asset, SMA 1-2 will also go wrong. Then the second one is that there are certain products, typically housing loan products which the banks have come out with, which is a drop line OD. Now instead of term loan, which is a typical product for housing loan, they are giving a drop line OD. So suppose say the housing loan is for 15 years. So over 180 months, your limit will get reduced, in a systematic manner. So it's a drop line OD product. Now let's take the similar example that someone has paid say 12 installments in advance, but it is a drop line OD. So in normal term loan, what happens is if someone pays 12 installments in advance, next 12 months he doesn't have to pay. Now here what will happen, that entire amount will get credited in your OD account, and subsequently you will be getting hit by one of the condition. There are no credits in the account, which otherwise is not the case for term loan. So the account will turn into NP after 90 days from the 12 installments which are paid in lump sum. Now what these banks have done actually, they have categorized this product under OD. So the product type is OD, because otherwise you cannot issue a checkbook. But when it comes to NPA norms, they are applying that norms which are applicable to term loans. You cannot have mix and match, kind of a concept, or you cannot have convenience of, whichever is better one for me. So verify these drop line ODs and see that you are applying these criterias and not the term loan criterias. RBI has amply made it clear, because there were few banks who have raised a question about that since it is not a business loan, we need to treat it differently. So RBI has already clarified in 2020 itself that whether the purpose is for business or personal or anything, once it is a OD, these conditions will apply. So whether it is a OD against property, whether it is a drop line housing loan, whether it is a OD against gold, the logic applies, by the same fashion. It doesn't undergo any change. Then the second, common issue actually which we talk about is about the comparison with balance sheet date. The stock statement of March. So when you are doing audit of say March 25, naturally you will have an audited figure of March 24. So March 24 figure and March 24 stock statement figure. Many times there might be a deviation which might be of a material amount. If it is not of material amount, maybe 5% or 10% is there, which is not going to affect your DP, it's fine that you can simply pass a passing remark in LFR and ignore it. But what if it is 50% deviation? So naturally your DP is going to get affected, and typically the argument is there from audit side that it is 12 months old statement. You have the latest statement. So even if there is an aberration is there, it is not going to affect my today's DP. Now this argument itself is wrong for the simple reason, or other two reasons I should say. First is that presuming that the stock statement which was given in March was correct, so either the banker has to say that whether it is a correct stock statement or whether it is a fictitious stock statement. If it is a calculation error, giving benefit of doubt to the borrower, then that calculation error should have been rectified in between the year. So suppose earlier my stock was 10 crores as per stock statement, and now in audited I am saying it is 5 crores. I came to know that there is a calculation error in the month of August, during statutory audit. So in August month stock statement, I should categorically say that there was an error, I have corrected the stock statement. If that is the case, it's perfectly fine. There is absolutely no issue. The borrower, on its own, he is admitting that there is a mistake, he is rectifying that. But if he hasn't rectified that, it means that either the stock statement was fictitious, because it is deviating from statutory, audit reported, figure. If it is a fictitious stock statement, just refer to the master circular of fraud. It talks about fictitious stock statement, which you can say that it is a fraud account. Whether to call it as a fraud account or not, it is your prerogative. That is one way to look at that. Second is, another way what I will do as an auditor is that, suppose there is a 5 crore difference. If it is not rectified, I will say that that 5 crores has to be reduced from subsequent stock statements also. It's a rectification of error. So naturally I have to rectify all my 12-month stock statement and then arrive at the correct DP, and based on that I will say that whether it is a PA or NP account. Choice is of the bank. In the sense you have to ask the bank, to ask them that how they are going to treat it. Either let them say that it is a fictitious stock statement, which typically no one will say, or admit that there is a error, so rectify all your DPs. There is no third option which is available. Third option is that ignore, that earlier, instances or say audited financial statement. So just verify, what is the reality. Then the next again a ticklish issue is about the reduction of trade creditors. Earlier few banks were there who used to argue that trade creditors are not required to be reduced. They don't have a charge on stock. Now firstly we need to understand that whenever we are giving a cash credit facility, it is a working capital finance. So the working capital gap has to exist. Then from that gap the margin is required to be reduced, which is a cushion for the bank about the realizability, and then whatever is left out is the DP. So which are the components? Typically 3 components are there. Book debts up to a certain age based on sanction letter, maybe up to 90 days, up to 120 days, there can be a differential treatment. For scheduled commercial bank, there is no upper cap about to what extent book debts can be financed. Unlike UCBs. For UCBs, the cap is only for 90 days. They cannot go beyond 90 days. Scheduled commercial bank, if a bank says that it is up to 1 year, it is up to them. It has to be written in the sanction note. So let's presume that it is up to 90 days. Then in that case, book debts up to 90 days plus stock minus trade creditors will be the figure based on which the finance will be done. Of course, reduced by margin. Whatever 25%, 30% margin is specified. So trade creditors, if they are not reduced, it means that working capital gap may not exist and naturally DP may not exist. So verify that with the audited financial statement and actual data which is specified. Some banks are innovative actually. What they do is, they write a small footnote, asterisk and a very, you can say a small font. They say that only give figures of paid stock. So they presume that the stock which is given is a paid stock. Now this presumption is hazardous because you will never come to know that, what is the quantum of stock and what is the quantum of creditors. Now this stock statement format itself is faulty because you will never be able to monitor that. Because ideally, like book debts also, creditor are also required to be monitored. Opening creditors plus purchases minus consumption should give you, the stock figure. Creditors also, openings, creditors plus purchases minus paid will give you a closing figure. You cannot have only paid stock reported and only book debts up to 90 days reported. It means that only you are picking up only one part of working capital, presuming that everything is correctly given. So verify that whether the trade creditors are reduced or not, and there is no ambiguity about this reduction of trade creditors. Bank cannot say that it is their policy. If that is the case, because some banks will say that, as per our policy, trade creditors are not required to be reduced. Just ask a representation letter from them by giving a hypothetical example. Tell them that suppose 10 is my book debt, 5 is my stock, and 20 is my creditors. So give us in writing that, for this working capital also the bank will give finance and there is a eligible drawing power based on your policy. Let them give that in black and white. Maybe 0.1% chances there they will give it to you. If that is the case, put that and highlight that in your main report. That bank is giving finance against negative working capital and calling it as a cash credit finance. See, these are simple accounting rules or accounting principle. When I am saying that working capital finance is there, working capital should exist in a positive way. It cannot be negative. It is not, it's not like a asset finance, scheme which the bank is doing. If that is the case, let them do that. Then your primary security need not be stock statement. It can be maybe immovable property or something else. That is the bank's prerogative. But once they say that it is a working capital finance, primary security is stock statement, naturally, the components of working capital should follow. Then as far as relational NPAs are concerned, many a times, it happens that CCOD might have been marked as NPA for a particular reason, and other accounts might get marked as a NPA because of relationship. Now, whenever the upgradation is, happening, the account, because of which the account has turned into NPA, firstly, that flaw should get removed in entirety. So suppose it is continuously overdrawn, one has to ensure that, the continuously overdrawn composition should be removed. But always remember that it should not happen that one of the flaw is removed, but by that time there is another account wherein some new flaw has got developed. So the basic rule is that on the date of upgradation, there should not be any overdues and there should not be any NPA criteria which is applicable to any of the exposures on that date. If both these conditions are satisfied, you can very well upgrade, that particular component. Now, one more thing is that as far as this coverage of interest is concerned, the concept is about coverage and not realization. The third condition, that credit summation should be more than interest debited. So let's presume that you are in a block of 90 days. Let's say 15 December to say 15 March. And every month interest is at 10,000 rupees. So December interest is 10,000. And, or, let's take this example. Anyway, I have just calculated that. So say the last quarter I have taken as a sample. So I'm having 1 lakh rupees, which is a disbursement which has happened on 1st of January. 2000 is receipt, and then 1000 rupees interest entries are there. Now this account in block of 90 days, because 2000 credit summation is less than 3000, naturally the account will turn into an NP account. That is a natural fallout. Suppose this 2000 were 5000, the account is a performing account because your credit summation is on the more side. So what we are comparing is whether the credits are able to cover the interest debited in the same 90 days period. It is not realization. Realization is subsequent to account getting marked as NPA, not prior to that. Now let's look at how the CBS behaves. Few CBS systems are having a kind of a strange behavior. They call it as a look back period. Now what is a look back period? On the date of NPA. So the NPA date might be say 31st March. So they mark that account correctly on 31st March, and then they say that in last 90 days, whatever credit summation is there, I will reduce from interest, and balance I will say that that is unrealized. So in this case, some CBS systems say that unrealized interest is 1000, which in reality is 3000, because 2000 is already adjusted against that 1 lakh rupees. So your principal, in the sense balance is adjusted, subsequently there are interest debits. So interest unrealized component has to be 3000. Now interestingly, all these CBS systems behave differently for term loan and CCOD. So let's take your parallel example. Presuming that this is a term loan, forget about EMI and other thing, the account is marked as NP on 31st March. They say that there is no look back period for term loan. So they will have 3000 rupees marked as unrealized interest if it is a term loan account. If it is a CCOD account looking like this, they will say that no, look back period of 90 days is there. So net is only 1000. So 1000 is unrealized interest. Now differential treatment to CCOD and term loan for realization is not specified in RBI circular. Any advance account, once it turns into NPA, you have to calculate unrealized component and reverse it. There is nothing like different treatment for term loan, different for CCOD. Treatment has to be uniform, and the accounting convention has to be followed. Whether subsequent credit is there or not, or advance interest accounting has to be there, which is not the reality in any of the bank's CBS system. Now accounts with temporary deficiencies. There are two temporary deficiencies which are defined. One is non-submission of stock statement. Second one is non-renewal. And there are interesting cases are there as far as these instances are concerned. First, let's talk about stock statement. Now the convention is that RBI has given a leverage to large borrower accounts that if you submit a stock statement, you can use the DP for the next 90 days. So my September stock statement, I can use it for DP of October, November and December. Subsequently, I cannot use. So practically the account might turn into NPA on say 31st March. Now, in this particular case, the leverage which is given is only for large borrower accounts and not for other accounts. Now, what is large borrower account? It is not defined. So as an auditor, you need to apply your yardstick. The easiest yardstick is that you can say that the annexures to LFR which are there, you presume that it is a large borrower as a presumption. So any smaller, small ticket loans are there, maybe 1 crore, 50 lakhs, you cannot apply this yardstick. So in that case, September stock statement can be used only for October. So November, December, January will be without DP, and then the account will turn into NPA on January end, not in March end. So apply this yardstick or leverage rationally, and it is not for all the CCOD accounts, it is only for large borrower accounts. Second one is non-renewal cases. As far as non-renewal cases are concerned, the short reviews which are there, these are not required to be factored into that. They are redundant. They are only for operational purpose. So if my account is due on 30th September, if I do a short review, maybe for 3 months, my counting of 180 days will not get postponed to 1st January. It will be from 1st October itself. Now what is the challenge in CBS system? CBS system has only one field, expiry date. So what the bank does actually, even for short reviews, 30th September will be changed and new date of 31st December will be put in. So naturally CBS will not work. It will calculate only from 1st of January. There are few banks, wherein their credit policy says that short reviews can be done 3 times. Initially at branch, then region, then maybe zonal. Now permission of, giving permission for short review is fine. Even NP accounts can be renewed. But your asset classification will not change because 3 times you can do a short review. You cannot keep on postponing it. And the very reason why short review is there, the reason is that because the borrower might not have submitted certain data to the bank is not in a position to do it comfortably. So that is the reason why you are doing a short review. So naturally there is a lacuna, it's not a full-fledged renewal. So 180 days norms are for full-fledged renewals and not for after the date of short reviews. So verify, how that it is calculated. How to identify these accounts is take a list of accounts renewed during the period and take a list of expired account. And then just correlate, that renewed during the period, just pull up the sanction notes and see that, whether it is a short review or whether it is a regular review. One more thing is that many times in the month of March, this 180 days gets over. So they, try to tell you that borrower has submitted the proposal at head office. Head office is yet to sanction that. Now what is required to be completed is that the conclusiveness of renewal is required. Now what is conclusiveness? Two, three things are required. One is application from the borrower to renew the facility. Bank cannot do it suo moto. Second thing is that there has to be a proposal which has to be approved by the bank. In the sense, sanction letter has to be there. And third important thing is that that sanction letter has to be accepted by the borrower. Unless and until sanction letter is accepted, your renewal process is not complete. So if all these three conditions are met before 31st March, then only you can say that the account is renewed. If the process itself, suppose the sanction date is 5th of April. So you cannot say that on 31st March the account was renewed. There is no retrospective effect. So just pay attention to the underlying documents which are there, and based on that you need to take a call. Then advance against FDs, NSCs, KVPs, IVPs, there is an exemption till the time the account balance is well within the limit. Now it might happen that other accounts are turning into NPA and you have a FD against, say OD against FD facility which has got the exemption. So verify that how the system is handling these cases, because typically most of the system go by custody. So they may not pay attention to which type of facility is there, which type of underlying security is there, because based on that the account has to be marked as NPA. Same way for central government guaranteed accounts, the account, even though otherwise it is NPA, it should not be marked as NPA. The reason being central government guarantee is there. But only one condition is there in such accounts, even though the account is PA, interest will be recognized on a realization basis. So the status of account is standard, income is recognized on a realization basis. Now let's look at the CBS system and how it is supposed to be behaving. Let's take an example. There is a borrower wherein account is NPA. So CCOD is NPA. There is a term loan which is NPA. There is second term loan guaranteed by central government. There is one LCBD of third party bank which is discounted. There is a fifth one LCBD discounted by the same bank. For each actually there is a different behavior. Normal is that NPA will get marked, interest will be on the realization basis. Central government account is PA, income realization on a realization basis. LCBD of third party bank, account is PA, income is on accrual basis. LCBD of your own, the account should get marked as NPA and a realization basis. Now, just test the CBS system as to whether all these conditions are really met by the system or not, and whether the master data is available or not. Like central government guaranteed account, you need to have a field, kind of a flag, wherein one has to say that whether the account is guaranteed by central government, yes, no. Then only the system will work. System will not understand that this account is marked as central government guaranteed account. So verify the adequacy of master data, and then there is a question of whether the system-based NPA they are working or not. Then advance again gold loans. Lesser said is better, I suppose. There are n number of issues which are there. Let me just highlight couple of them. RBI has been harping that 75% LTV has to be maintained, and it has to be on a continuous basis. Now what does that mean? It has to be system driven. So naturally in master data, what should be the content? It should be only weight of that gold ornaments. And there has to be a master field which has to be centrally updated based on maybe current gold prices. Then only it can work. If it is not the case, it's entirely a manual process. You cannot monitor the 75% LTV on a continuous basis. So system will not work automatically. It's a manual intervention. So again, flaw in CBS system, contrary to what RBI is expecting the banks to do. Second one is that there are instances wherein evergreening happens in various innovative ways. The very primitive way was that there will be old account which will be closed out of proceeds of new account. Why I'm saying primitive is that maybe one of you goes there for audit, he identifies that, mark those accounts as NPA, because it is a clear-cut case of evergreening. So next year, the manager is aware that the auditor is looking into that, so he will have cash withdrawal entry and cash deposit entry. So new account will be opened first, cash will be withdrawn first, later on, the amount will be stated to be, closed. In fact, yesterday there was a WhatsApp message which I received. I don't know the authenticity of that. In one of the bank, an instance has taken place wherein same practice was followed. New account, old account will be closed, cash will be deposited. Now to overcome that timing difference, there are some banks which first close the account even though the cash is not deposited, and then show that there is a amount withdrawn from new account, so that auditor should not object because of timing difference. Now that bank actually did that first entry. They said that cash is deposited, they closed the account, and before the new account was opened, the enforcement agencies came into the branch. The borrower had already informed the police that I have deposited the cash and I don't want to take any loan now. So the amount has got deposited, entry has been passed, new loan is yet to be opened. So he's saying that the amount is deposited, look at your entries only. I don't know whether the incidence is correct or not, but there is a very possibility that this is very much possible. So be little vigilant about all these things. Not that we need to catch this kind of a scenario, but see that evergreening can happen in various innovative ways. As an auditor, you need to be vigilant. So take out the list of accounts opened and closed during the year. Try to match it. Ask the bank what is the process. Just try to pull the details about the timing of closure and timing of opening of the account, and just try to correlate. You will get a number of instances. I don't have to even get into how to get that. You have ample of examples, but be little vigilant about this kind of a business. Couple of additional things as far as borrower classification is concerned. It is borrower wise, that is co-borrower classification is there. But few common issues. There might be instance of co-borrowers. So A and B might have taken a housing loan. So if that gets marked as NPA, wherever A or B they are borrowers, all these accounts will turn into NPA. So A's vehicle loan, A and C's joint loan will also turn into NPA, but C's loan will not turn into NPA because it's not like cascading effect. You have to stop somewhere. A and B are defaulters. So anything linked with A and B will be there. C is out of that picture, but A and C loan will be marked as NPA. Now what is the challenge with banks? So the moment you mark A and C loan as NPA, which is a correct proposition, system will pick up that C's custody is also defaulter, and it will get informed to CIC agencies. And in reality, C is not the defaulter, only A is defaulter. But C also will get affected, because once you mark that account as NPA, naturally the fallout is in the same fashion. But vice versa, you need to also correlate that with capital adequacy. Now in capital adequacy, what we typically do is, suppose I am having a housing loan of 50 lakhs, I have a saving account balance of 5 lakhs. So I can knock it off. So my net exposure is only 45 lakhs. So the capital adequacy naturally increases. Now in this case, suppose A and B are joint borrowers, even B's securities, that is B's saving account, FD should also get knocked off. So when you see these joint loans, don't look at it only from negative side of NPAs. Look at it from positive side, wherein capital adequacy might be improvised and the bank may not be capturing that data. So give by way of suggestion that how the capital adequacy might be improvised, because joint loans are there. So naturally, B's deposits will also get knocked off. Now there might be certain loans which are having common securities. So even though security is common, it doesn't mean that all loans should turn into NPA. So it is based on borrower wise and not security wise classification. Only precaution which you need to make is, suppose you have a common security, how to apportion that between different exposures, whether it is within borrower, same borrower, or within multiple borrowers, and how the bank is able to handle that dynamically, because the amounts will keep on changing. Systems are not equipped, they don't have a custody, property ID concept. So there are natural fallouts of that, so verify that. 5 minutes? Yeah, sure. I will just cover a few of the things in 5 minutes. One is about the straightaway classification. So in this norm actually, if your earlier valuation compared with the current valuation, if there is a deterioration beyond 50%, then there are two things which you need to remember. If it is already marked as substandard, you have to accelerate to doubtful asset category. So your date of NPA and period of, the minimum period will not match. So maybe within 2 months also the account can go into doubtful asset category. So that is one. If the account is standard, then it is not necessary to mark it as a doubtful asset category, but one has to test it as to what is the reason for deterioration. Suppose there is a natural reason, like say there is a depleted condition of building, then naturally there is no fraudulent element involved. You can keep that standard account at standard. If there is an inflation in valuation, naturally you have to say that it is a fraud prone possibility. You have to say that it has to straight away be taken to doubtful asset category. Second one is wherever the realizable value of security is less than 10% of ledger balance. In that case, the account will turn into a loss asset category. Now, both these conditions are applicable only to secured loans and not otherwise. Now, how to decide whether a loan is secured or unsecured? Now, secured unsecured categorization is decided at the time of sanction of loan. So, at the time of sanction, if your underlying security is more than 10% than limit sanction, your account, that is that particular loan, is permanently secured loan. Subsequently, the nature will not change. Only composition might change. Some portion is secured, some portion is unsecured. But the type or nature of account will remain same, either secured or unsecured. So 10% is at the beginning. And this one is that on an ongoing basis. So this will apply only to secured loans. Because suppose I have only 5% security at the start of the period, my loan already is unsecured. So this condition cannot be invoked. So just ensure that this is applied only for secured loan and not otherwise. Now, as far as this erosion is concerned, the challenge in CBS system is that CBS will not be able to capture that whether it is a erosion or whether it is a replacement of security. So maybe earlier security was 10 crores, new security is 4 crores. My limit is only 1 crore. So naturally I can replace the security. Now this is not erosion in value. It's a replacement of security. So CBS has certain inherent limitations not to understand unless and until they are improvised based on maybe property ID or something of that sort. So don't presume that CBS will work the way you are thinking. There is no artificial intelligence in CBS system or per se in NPA norms itself. Normal intelligence is required. So what you need to think is logical thinking and then take a call as to whether the account is performing or non-performing. I will just touch upon the last part. As far as inherent weaknesses accounts are concerned, that is your prerogative and not the banker's. So if you see that there are sudden credits in the account, all of a sudden account is getting regularized, you need to ask the source of those funds. Now which are the source of funds which are legitimate? Maybe long outstanding demands are there against maybe some customer of that particular borrower which are realized now. Some court case might be going on. Now what is not so legitimate? The example is that suppose the borrower sells a fixed asset and regularizes the account. You cannot say that this is business proceeds. So there is an inherent weakness which is very well existent. Or suppose the borrowers, maybe directors are introducing the funds. This is not legitimate source. It's a capital funding. So if you regularize that by capital funding, your income generation activity itself is doubtful. Because you are not able to generate the income which is more than your EMIs or more than your demands per se. So take that call prudently. And challenging case is that many times there might be FDs created out of profits in earlier year. Now those are liquidated, the account is regularized. You will not even understand the account is regularized by that way. So be little vigilant. Liquidation of FD is not the regular source of income. It can be one-off source. Earlier there is a substantial portion which you have said and other thing is fine. But it cannot be sustainable over a longer period. And definitely not at the end of the year. If that is the case, it should be throughout the year. Out of earlier saving, I can keep on repaying. I cannot suddenly regularize my account, by way of liquidating something. So be vigilant about that. And last but not the least, as far as NPA classification is concerned, there is no materiality concept. So materiality concept is for passing accounting entries related to profit and loss, not for classification of advances. And another thing is that there is nothing like central auditor, dropping any MOCs which you are passing at the branch level. I have never seen a central auditor who says that I will just bypass the MOCs of NPAs which are passed by the branch auditor. Just imagine that you are in his place. You will never like to take orders of the branch actually. You are already having the top 20 branches which are more than sufficient for you. So no one drops any MOCs. Let the bank say whatever they want to say. You can say that you can drop at head office level. That is the easiest way. You convince the central auditor or whatever you want to do, you can do. At the branch level, you need to close that. Don't keep anything open about NPAs at the branch level. And as far as project loans are concerned, just to touch upon, just two things. Whenever project loans are there, vital factors are date of commencement of commercial operation. Be little vigilant about that. The reason being, in certain cases, there might be a partially completed project. So they might be saying that deemed DCCO is achieved. Deemed DCCO, the condition is that at least 50% project should be completed. It has to be up and running. Otherwise, it is not deemed DCCO. And for restructuring of project loan, there are conditions which are prescribed. So if they are within that framework of extension of DCCO, restructuring is possible without losing the class of asset. But in all other cases, wherever restructuring is there, the account has to be downgraded. And then satisfactory performance condition is the one wherein the account can be upgraded. To look at it in a positive way, if the account is having kind of some economic challenges, account might turn into NPA by natural fallout. What a prudent banker should do is that he should restructure the account. If it is a MSME, the conditions are very easy. Within 1 year, you have to prove that it was not overdue beyond 30 days for entire 12 months. The account gets simply upgraded. If it is non-MSME, again, 10% has to be paid, or 1 year, whichever is a higher period. If there is a satisfactory performance, is that account gets upgraded. So rather than simply having an account turn into a NPA category or a substandard category, if he's a genuine borrower, the best way for banker is to restructure. So maybe in March 25, anyway the account was going to be NPA. Suppose I was a banker, I would restructure that account, make it substandard on my own. But by March 26, the account is eligible for upgradation. So there is no additional harm because of restructuring, which of course as an auditor you need to be aware about, but you should not become advisor to them. Don't advise them by going extra mile by saying that restructure all substandard account, they will turn into performing assets. Because the challenge over there is RBI has not prescribed how to restructure account. You can have a restructuring for 15 years also. There is no norm, especially for MSME. At least for others, at least 10% repayment is required. For MSME, even that is not required. So there can be n number of wonders which one can do at the time of restructuring. So be little vigilant about verifying the restructured files and see that whether you are satisfied with the logic behind that number of years. That the project should survive for those many years. You cannot have 15 years, 25 years of restructuring just for the sake of it. So thanks for all of you. Thanks for patiently listening. I just tried to cover as much as possible. Any questions are there, we can take up in question answer session. And thank you to Ketan once again to invite me over here. And it's always a pleasure to interact with all of you. Thank you very much.
Thank you so much, Dhananjay. Before the formal vote of thanks is being given, one very quick update. Next session is of auditing into Forex, and we have both worthy speaker here. One error on my part. We planned a Forex session in two parts. Basically, one non-funded to be taken by Mehul Shah and funded was to be taken